Let's Invest Right. And again with me, Mr. Ehsan, and me myself, Farooq. Ehsan, out of those 7 key fundamentals which we are discussing and which every investor would like to know, which one of them we are going to discuss today?
So now we'll be discussing about the debt to equity ratio.
So we are going to discuss about debt to equity ratio. Yes, Ehsan. So why is this ratio so important to look before making a decision?
First, we need to understand what is it. So debt to equity ratio is the total liabilities in a company.
Okay.
So it's financially we do it like total liabilities divided by total equity of the shareholders. So the higher the ratio, the more debt the company has. Why is it important? So if you're investing in a company, you should know how much liabilities the company has, how much it has to pay to someone else, right? How much equity does it have? The higher the ratio of debt to equity ratio, the higher the risk. The reason is whenever the company gets bankrupt, whenever the company gets dissolved or it cancels out its operation, first of all they pay to their debt. So the liabilities are paid off first and then the turn comes to the shareholders. So therefore it's important to analyze the debt to equity ratio.
Is it possible like any company at this time like they would be having completely zero debt, or we should be looking for a company with comparatively the lower number?
Yeah, so generally we should be looking for companies that have low debt. Like some debt is important. Reason is it gives you leverage, because if you see the profit and loss statement of a company, debt has a fixed cost, which actually whatever the assets the company has raised, it has 2 sources, liabilities and its equity, right? So if it has some liabilities, then it helps you to increase your earnings per share, profitability, and maximize the wealth of the shareholders. But higher the debt, it's higher the risk. It also increases the chances of insolvency or bankruptcy.
Great. One more thing, one more important aspect which I would like to discuss with you, or if you can give us your thought on that. When we talk about debt to equity, yeah, what do you think? Is it like a sure thing which we need to really see, or this is only one of those factors among other key factors?
See, it's very important. It's one of the most important. Why? The reason is when the market is going up, everything looks good, looks green, right? And you are making profits in the long run, it looks good. But once the market goes down, it starts going down, companies with low debt will only survive. Companies that have, if you see last few months after the COVID-19 impact, many companies have announced bankruptcy. Hertz, California Pizza, many others, right? And if you see their structure, they have high debt in their P&L, in their balance sheet, sorry. So with high debt in their balance sheet, they were not able to pay off their liabilities in the next few months.
So in other terms, when we are investing in a stock, we are becoming the owner of those, we are having the ownership in those,
exactly,
in terms of having shares, whatever we can afford, or whatever being offered to us. So we would not like to be the part of the company which has a lot of debts, and we are not certain that whether they will be able to pay back those debt with the current revenue streams, or if they have uncertainty in their revenues, like what we have seen during this pandemic.
Yes.
A lot of companies were not able to generate revenues, and hence they were unable to pay their debts, and they have to apply for bankruptcies, and eventually the debtors were given the right first.
Yes, so if you see how it works, the debt has to be paid first. There's an interest payment on the loan, on the bonds, on the debt, in whatever form they have raised it, right? So this payment has to be made, whatever the scenario is, whether the company is making revenue or not. Whatever the situation is, they have to be paid at that time. If these are not paid, if these payments are not made to their debtors, right, then the company, and they have no money, for example, then they will be announcing bankruptcy. This is what bankruptcy is. So it increases your risk. I know it increases your return, but it increases your risk. So you have to have a mix, or the right mix, between the debt to equity.
As another important aspect, if I would like to add into this, is in the countries which are going towards increasing the interest rates. Yeah, like although these days we have seen the trend is going downwards, like countries are decreasing their interest rates, but if it's the other case round, then the cost of financing increases, so companies' earning per share will also go down, right? Or it will decrease with time.
See, Farooq, it's a relationship. If you see, when the interest rate goes up, right, then the debtors would be asking for higher return on their investment. Similarly, there's a shareholder who's investing money who's taking the risk. So debtors are not taking the risk; they are taking lesser risk than the shareholders. So in turn, shareholders will ask for a higher return. Otherwise, if shareholders will not ask for a higher return, or the company is not able to give higher returns to the shareholders, then
in terms of dividend, you're saying?
Yes, in terms of dividend. Otherwise, if they are not paid more, then those shareholders will invest in bonds or debt to the company rather than investing in the shareholders.
Yeah. So overall, the scenario would change, and the sentiments
yes,
of the market would go towards the capital markets.
Yes, it could. It could. See, it could, or it could not. It could go either way. But just to add this, when the interest rate increases, the weighted average cost of capital, which is, so a company raises its capital either through debt or through equity.
Equity, yeah.
So equity, they pay a certain percentage, like EPS or dividend, whatever, and then interest is paid to the debtors, right?
Yeah.
So there's a weighted average cost of capital. That weighted average cost of capital will also increase with the increase in interest rate.